Hello, everyone. Jeff Fratarcangeli here, Fratarcangeli Wealth Management for a live market update, a longer version than our Friday Fratarcangeli market updates. We're going to get a little bit more in depth, and we typically do these types of gatherings when the market's going through some turbulence or uncertainty, which I think the last, call it, week or two has proven to be. And that being said, a little bit about our firm before I get into that. I'm so proud of my team of 35 professionals that have been built up over years and decades since 1995, when I started in the World Trade Center training to be an advisor and building a team and such, that has now led to us being now for the fifth consecutive year in the top 100 in the nation for wealth management, ranked by Forbes, which was just announced, as well as the third consecutive year of being ranked #1 in the states that we are located, which, of course, being from Michigan, my home roots of the Midwest, we're always proud to lead. And so I couldn't be more proud of our team of relationship managers, administrative staff, head of retirement division and planning, as well as benefits and all sorts of different things that have evolved, that we really focus. Very simple. What would I want if I were the client, and if I were the business, if I were the individual, the family that needs guidance and counsel on all fronts? And that's what we do. We look at every side of the balance sheet and all details, from the debt, from the expenses, including healthcare, which has shot up in the level of cost on the balance sheet of what's most expensive, and down that list, it's the third. It's outrageous in healthcare, property and casualty, and depending upon where you're at in the country, those prices have gone up exorbitantly. So we need to make sure we create a competitive environment for our client on all solutions, as well as with the investment world. And, listen, I've been doing this since 1995 with the passion you would hope, getting up every morning, making sure I'm healthy and ready for the day, and learning and listening to everyone that you would want me to leverage and learn from, including all the publications and, CNBC and all the different Fox and CNN and MSNBC. And the gentleman I'm going to introduce, you see him on those shows. So I leverage the folks that I trust, that have led us right, to talk about. So it's not always our voices here at Fratarcangeli Wealth Management, but it's from the front lines of people that, in this case, Bob Carey, who is the, let me put on my readers, as I've gotten to the point in life where I cannot see close up. You didn't warn me on that one, Bob. You left that one out.
Oh, I got plenty of things to warn you about. So,
well, you don't look as if you should be giving me advice on age, but thank you. Mr. Carey has been in his position of a leader for the last 3 decades on equities and fixed income as an analyst, a chartered financial analyst, a CFA, which I will tell you is a master's and a PhD combined. If any of you have sat for any of those tests, good luck. Mr. Carey is a chief market strategist at First Trust Advisors, which oversees $300 billion. When I met you, I think you managed like 300 million. So Bob, good work there. Mr. Carey, as I mentioned, Bob has been on Bloomberg, CNBC, Fox. He's been quoted in the Wall Street Journal. More importantly, he's been on our show, which is where most of us get to see him. In that, I remember being in front of a crowd back in 2015 and 16 before the election, and 17, I guess, kicking off for the 2018 leadership change that we're involved in. And you said some things. You gave us guidance. You talked about the fact that everyone was scared and nervous, and yet when you looked at valuations of the market compared to bonds, there was no comparison. Equities were way undervalued, and we've evolved since then. You've been dead right. You've guided us through change in leadership. You've guided us with policy that has come down the pipe at times that we're not sure how to interpret. Here we are today, coming off of the longest shutdown in the history of our government, and the market's really kept pretty stable during that time. But on the post reopening, which has just transpired in the last week, the markets then started to show the hangover. We've had 4 consecutive days of decline. We're down 4% from our peak, which was at the end of October. We've just ended earnings season, right? We just ended earnings season, which we had some really robust numbers by the S&P 500. We've had 5 consecutive earnings, double-digit earnings growth years. We had a profit margin increase to 13% above, which is above the average that we've seen consecutively. The quarter also marks the 7th consecutive quarter of earnings growth, which is unprecedented. We are now trying to assess why the markets are contracting, why technology is leading us down this decline. NVIDIA reports after market today, which is going to be polarizing, and I think we're all waiting to see those numbers. And, it all started with Palantir announcing earnings. And that's when, oh my God, world's coming to an end. We have a bubble. The world's, I've been sitting here for 30 years. I've heard it 30 times a month. So that being said, I'm really leaning on you, Bob. And we did not talk about your opinion of this because I wanted to hear it fresh with my audience. So what says you? Where are we?
Well, yeah, a couple things. I think obviously the government shutdown got all the headlines, but I think what's really driving volatility here in the last couple of days is the diminished expectations that we're going to get a rate cut from the Fed, coupled with a decline in the price of Bitcoin. There's no doubt that a lot of folks have purchased a lot of equipment over the last 5, 10, 15 years to mine Bitcoin. All of a sudden, Bitcoin prices are down. And so I think some are worried that that will cause some demand to fall for companies like NVIDIA and the like that make the chips and all the servers that go into mining Bitcoin and other cryptocurrencies. I think all of that, it's not the first time we've had this scare, but I think underneath it all, I didn't hear anything from anybody who reported in the third quarter that business was slowing down at all as it related to technology. If anything, companies beat expectations. We're starting to hear from other industries what they are planning to do with AI, which I think is, really is going to be the long-term key to the build out that we're seeing in data centers and so forth. When all of a sudden we've got healthcare companies and the like talking about what they plan to do with artificial intelligence, it's exciting. I think one key difference, I get this question all the time, and I'm sure you do too. How is this different than the late 90s? Obviously, anybody that was around back in the late 90s remembers we had a lot of companies skyrocket during the late 90s. You think about companies like Cisco and the old Sun Microsystems and the like. These companies did really, really well. AOL, as we started to use the internet for the first time. The internet was more or less introduced in the mid 90s, and by the year 2000, it became very clear, hey, we're moving towards the internet. What really set us back and caused the internet bubble to burst like it did from 2000 to 2003 is that it took us a lot longer to roll out broadband access to the internet. We were using dial-up, and dial-up was incredibly slow. All of a sudden, we're laying fiber optic cable all over the place. We had all these companies that were essentially the backbone of the internet borrow a lot of money. It took a lot of IPOs. It took a lot of leverage to construct the infrastructure needed for us to move to broadband internet technology at the end of the last century and the early part of this century. And that took a lot longer. There were a lot of regulatory hurdles that popped up, around the year 2000, and all of a sudden demand for telecom equipment collapsed. And we saw companies like Northern Telecom collapse. Cisco went down. Cisco has yet to completely recover from where the levels that it was at. There was no doubt valuations were very, very high. I think what's different today is AI is more or less the cloud, and the cloud has been around for a long time. We've had data centers, we've had the cloud. This is kind of the next step in the move towards data going into the cloud, and this is going into the cloud on steroids, if you will. It's amazing the recognition suddenly that we just don't have enough electricity, we don't have enough data centers. It is a mad scramble to accommodate the amount of data that we are beginning to produce. If you look at the amount of information that we see in the economy, it is going up exponentially. Most of the financing of the data centers, of the build out, is being handled by companies that are in the technology space. So a lot of this is coming from successful companies that have a lot of cash, have tremendous cash flow, very, very high return companies. And when you look at, just take a step back at the technology sector, we were essentially expanding balance sheets by 20% a year back in the late 90s at a time when those companies had 10% returns on their business. In other words, it took a lot of external capital to grow. And it's very hard to grow your business when you don't generate enough cash flow, enough capital, and that was the cause, in my view, of the big meltdown that we had in that phase. A lot of folks are comparing that, whereas today we've got companies expanding their balance sheets at about the rate that you would expect, given the fact that companies today in the technology space, on average, when we aggregate all these companies together, have 20% return businesses. And that's a near doubling of the rate of return that companies generate. You mentioned margins. That's where a lot of this comes from. We have much, much higher profit margins. We've got a lot more free cash flow to be reinvested. Yes, there is some leverage being sold. Companies in some cases are realizing that, hey, it might be better to have some debt in this equation. Debt is, interest expenses are still just that tax deductible. So I think you'll see a combination of leverage as well as just, companies just using their free cash flow to build this thing out. But it is really quite different, I think, from a financial perspective compared to what we saw back in the late 90s. Now, it doesn't mean that this is going to go on forever and ever and ever. We're not going to have some companies get over their skis and make bad investments. There's no doubt, in my mind, when you have these massive capital expenditure booms, you are going to have, at some point, some companies realize that they really did not spend and invest wisely. But I think most of the companies, in fact, overwhelmingly, the companies that are making these big investments, by and large, are successful companies. Now, we've got a bunch of companies that are still private, that are raising capital like crazy, and their valuations are, I would call them eyebrow raising. And when you look at these companies, when they don't have any,
you're saying the private companies.
Yeah, the private companies.
Anthropic, is that one of the ones you're thinking about?
Yeah, absolutely. OpenAI and Anthropic are the poster children.
They were just on 60 Minutes. They were talking about them the other day.
Yeah, and these companies don't really have much revenue yet, and the revenues they are.
So that's the .com difference. You had companies that would use the word .com. Let's use that as a parallel to AI, and all of a sudden the stocks would go, and yet they weren't making any money. What we have today on the public markets, what says the difference?
Yeah, we've got public companies they're highly profitable, and they don't have to go out and do IPOs at this point. They don't have to do a lot of debt financing. We had a company, I'll never forget this. This company back in the late 90s, it was PSI Net is the name of the company. PSIN was their ticker symbol. They were building out what they called a competitive local exchange network. In other words, in order to get on the internet, you were going to need to do business with this company. It was kind of a telecom type of company. And they ended up, I think at one point they had maybe a couple $1 billion in revenue. They had $20 billion in debt. They named an NFL stadium was named after the company. And as it took a lot longer for their network to be utilized, the company crashed and burned. And the fact that their ticker symbol was PSIN, and if you say it phonetically, you'll see what I'm getting at. They literally, a lot of capital got sent down the drain. So I think today, we'll probably have a couple of these companies that just don't quite exceed the expectations or meet expectations. But I think by and large, I think most of this investment, I would say, is much more organic. The success or not of OpenAI or Anthropic, you mentioned, these are big investments, but by means they're not everything. And a lot of people, when they watch CNBC or 60 Minutes, they think, oh, this is what it's all about. And believe me, there's a lot of companies out there that are going to be huge players in technology and AI as we go forward.
Let's stick to the tech topic, because I do think it's been our catalyst in any environment of growth and expansion, markets and and improvements of productivity, not to mention what we're experiencing today to be polarizing, in that we have companies that are referred to as the Magnificent Seven, or the tech, call it market, being such a 27% growth year to date on market performance on tech coming into November, compared to the second place being 24% in industrials, which is also data centers. And then you go into
very much so
financials at 22. So they're the leader by a large margin, and they're substantially above the market average returns in the S&P. So they're the leader. And I hear these, and listen, I'm not going to say I'm an expert here, but I hear this, well, NVIDIA's lending money to this or investing into this group, and then they're turning around and buying our chips. What I heard you say was the energy infrastructure that's necessary to allow this to continue is needing a robust amount of infrastructure built out and probably capital to allow it. It sounds to me like they're saying, hey, in order for us to continue to move in this direction relative to the progression of AI and its impact, and us to profit from the, call it chips that are needed for this, I need people out there doing the things for the infrastructure to allow the progression. But
That's right.
that to me seems logical. But what's being spun, oh, you got my back, I've got your back mentality. That's not what's happening from what I'm hearing you say. Do you want to expand upon that listen, guys
Sure.
out there listening? There's always going to be the naysayers out there when it comes to this type of growth. And I'm not saying they're wrong. I'm saying let's dissect it, because there may be ulterior motives for that contraction to occur for some investors as well that I've seen over 3 decades. So I ask you, Bob, is this something that you see pay to play, or is this really something that, hey, in order for us to continue and we're making the profitability that allows us to lend and give the infrastructure an opportunity to keep up? What is it that you see?
Yeah, I think it's very simple. Companies, like NVIDIA and a couple other companies, Microsoft and the like, these companies have got cash flow like we have never seen in the history of the world. And we've never seen companies generate the kind of cash flow that these companies generate from their businesses. It is incredible. And I understand some people hate that. Maybe they hate capitalism. They don't like this kind of thing, but it is what it is. Companies are generating a lot of cash. So if you have a very, very high return business, you are always looking to, if you're going to reinvest all of that cash flow you're generating, you are going to look for higher return, high growth reinvestment opportunities. And when you are in a position that these companies are in, they are on the ground floor of dealing with all of this investment and all of this data boom, if you will, happening in technology. So what always concerns me is when companies are successful and they turn around and they buy into other industries that they are not in. And a classic example of this is at one point during the energy boom years of the late 70s into the early 80s, Mobil, the big oil company, went out and bought Montgomery Ward, a retailer, a completely different business, not related at all to the business of getting oil and gas out of the ground and refined and sold to you at the gas station. It really, if companies start doing that kind of thing, that would concern me. I think companies are realizing they have an expertise. They want to leverage off of that expertise and their knowledge of the markets that they are serving and that they're in the middle of. To me, this is healthy. That companies are reinvesting. Does it mean that every investment's going to pay off? No, it really doesn't. It's not. These aren't guarantees. But the one thing that I would point out is that most companies, when you value any stock in the stock market, we're always looking at the company as they're configured right now. What are their assets right now? What are those assets doing financially and operationally? And then the question is, what do they do in the future? And every scenario with a balance sheet, with reinvestment, with rates of return on capital, all of that represents a scenario. And believe me, we take every one of these scenarios and we go back and forth. We take a scenario that is rosy. We come up with a valuation, and we'll take a scenario that is highly negative and, company making bad mistakes and returns falling off and all that. And then we'll come up with a valuation. And what I am seeing and what I didn't see back in the late 90s is I'm seeing successful companies, the share prices basically imply that there is going to be a contraction at some point. There is going to be a fade, might be a better word for it. That's usually the term that I use. Companies that are successful, they don't stay successful forever. Eventually, companies hit the wall. Something happens. Companies that we looked at as being unstoppable 40 years ago, a lot of those companies were, in fact, defeated by the marketplace. And so it's reasonable to price in a fade at some point down the road. And right now, it's not unusual to see a successful company with rates of return expectations going forward that are, maybe half of what they are right now. And so I think we've seen this by and large for the last 5, 10, 15 years, pretty much ever since the financial prices, we have seen expectations of a fade for some of these companies, be it, Nvidia, Apple, Microsoft, all these companies. And the reason the stocks have done so well is they've beaten the fade. They have beaten those expectations that have been baked into the share prices now for a long, long time. If it ever comes to a time when we don't see a fade baked into the share prices, where we don't see, a 5-year return expectation baked into the share prices, that's when I would get concerned about valuations, and would be very concerned that investors are maybe not taking into account the possibility these companies could be making bad decisions with their businesses. But I would say, by and large, right now, most of the companies out there, successful companies, do have a fade baked into the share prices.
So what I interpret you saying is companies are pricing in some of the upside, but more of a potential contraction.
It's reasonable to price those in. We know we've got history going back 75, 80 years, and we can see when companies have been successful in the past, what do they look like 5 years in the future? And we map this stuff out looking at the history of capitalism. High return businesses eventually attract competition. They attract maybe regulation, obsolescence. All of those things are still very much with us, and will always be with us, and we're mindful of those things. It doesn't mean that the market always gets it right. I think if anything, the market, I think, has been underestimating just how well companies are doing in terms of running their businesses. Right now, the return that I calculate on balance sheets for companies in the S&P 500 is now 11%. In other words, for every $100 that companies have invested in their businesses, in their balance sheets, and every company has a unique set of assets from an accounting perspective, 11% rates of return are almost double what they used to be 40 years ago. You go back throughout most of the 1950s, 60s, 70s, into the 80s, into the mid 90s, the average company in the S&P generated about a 6% rate of return. So we have seen, really since the advent of the internet in the mid 1990s, we have seen companies get better and better at what they do. And it's not just technology companies, it's companies that tech companies sell to. One of the best examples that I can give you is in retailing. Two of the biggest retailers in the country 40, 50 years ago were Kmart and Sears. Those companies dominated. They were the biggest retailers in the world for many, many years. Both companies had about 5.5 to 6% return businesses, and took about 6 months to sell all of the inventory in their stores. Well, we've got Amazon, we've got Costco spinning that inventory, turning that inventory in less than a month, we estimate, with about the same profit margins. So essentially, these companies are getting better and better at doing more with what they do. And the most important, you're really managing you're managing your inventory if you're a retailer. So the impact of technology extends far beyond just the tech companies. It extends to financial services companies. It extends to utilities. Extends to retail. But to me, that's the exciting thing, is that investors, I think, at some point, are going to realize that technology is going to benefit a lot of the economy, a lot more than just the technology companies. It's tempting to look at these companies and go, look how valuable these companies are. They're crazy. Their owners are rich, greedy people, and of course they are. And but I think the impact now is being felt in sectors such as utilities and water and things like that. It's a lot more than just the technology companies that are impacted by this boom in technology that we've seen.
The efficiencies and the productivity that are created from technological advancements have allowed the earnings growth, as well as the return on capital, to go up so substantially. And going back to your point, when I was watching the S&P 500's outlook and earnings growth on a consistent basis, going early days, call it 90s, 4 to 6.5% was about what you would expect. Today, as I mentioned in our initial call and introduction, was we've had double-digit earnings growth now for the 5th consecutive year. And now we're also looking at the projections that companies are relaying to us as early as this most recent quarter of third quarter results. And now they're projecting for 13% next year, and as well the following year. And that's a direct correlation to your example of being able to turn over inventory once at 1/6 time frame that it had been back at the time where I was predicting 4 to 6% earnings
That's right.
growth.
Yeah,
And yeah.
Jeff, we're at expensive level. I mean, there's no doubt about it. We're at about 22 times earnings next year. And you and I have been around long enough. You know that a 22 PE is not normal. We are not normally at 22 times estimated earnings. We're closer to maybe 17 times earnings. And so I'm not surprised that we would have some volatility from time to time. And typically that volatility has been associated with concerns, for example, back in the spring about tariffs, or now concerns that maybe the Fed doesn't cut interest rates as much as we thought. These kinds of things, they're inputs that we have to take into consideration. And the market is certainly pricing some of these things in. The Fed looked almost to be 100% that they were going to cut rates here. And I just got a little pop-up email from Bloomberg here that it's looking less and less likely that we're going to get a rate cut in December. Now, the impact is the 10-year Treasury is at 4.12%. It was at 3.9%. Doesn't sound like very much, but if you take a 20 basis point change in interest rates, it has about a 4 to 5% change delta on valuations for the market with nothing else changing. And so sometimes when we see markets going up and markets going down, we attribute the volatility to, whatever. It could be the government shutdown, whatever. But a lot of times it just really, I think, ultimately gets back to earnings and interest rates. And I don't think a 4% yield roughly on the 10-year Treasury is necessarily a high hurdle for the economy to overcome. I think that is a reasonably low cost of capital at a time when rates of return on capital are at record levels. And I think to me that always gets back to those two things from a financial perspective.
Listen, I'm going to summarize. What I'm hearing you say is that the market is at maybe a little optimism, but not the euphoria that you described when we're not taking into consideration as you put it, a dip or a consolidation or a not meeting expectation scenario due to competition and whatever else that's coming. That is a positive. Anytime you have a euphoria, call it phase, where we're swinging for the fences every swing, and we're not looking for doubles and singles and walks, if you will. That's a problem, and that's not what's happening here. You hear things like, "This is a bubble. This is the top," and I think you described some things that do not align to that. They just don't, as it relates to the consideration that every investor and every talk show host is really touching on. You don't have that euphoric feel that I felt going back to my early days in the late 1999 and as well 2000. Far different. You had companies that weren't making money, that just because they said they were .com companies going through the roof. Maybe you're getting some of that in the private markets, but we don't have that. We're going to find out today after market with the leader of that, call it earnings growth, that we've seen now consistently in that NVIDIA. And I think a lot of companies and people are waiting and holding their breath to that. The market's all over the range today. But what I will tell you is this is healthy. You have to reassess, you have to re-question, you have to double check, you have to think about things and really take a more gradual approach, as opposed to a go straight up approach, as opposed to grind higher, pull back, grind higher, pull back. I've oftentimes used the example, if you're building a skyscraper, and this economy isn't far from the largest building ever made in history, if you don't retest the floors below you, and you just continue to build and build and build, you're going to collapse down to that previous floor that was tested. And I think that's what we're dealing with today. If you think back to
that analogy, that's a great analogy, Jeff.
You think back to September of every year for the last 5 years. It's been the month of the bottleneck month, they call it, the month of consolidation and sell-off and fear. We didn't get it this month, maybe because of April, maybe because of different reasons, maybe because we expected it. One thing I've learned is when everybody says something is going to happen, it usually doesn't. That may have been the reason. And yet here we are in November having that month, right? And I think as much as I don't like the experience and the fear that it generates and the questioning of, are we doing the right thing? I know it's healthy. And maybe a rookie or someone who just started might not have that experience and that ability to navigate and understand. This is an opportunity, if anything. What I'm hearing you say on the tech side of things, we have a long way to go. We don't truly understand what tomorrow's, call it, experience and expectations will bring relative to what we anticipate. But that's why we question things. But The upside is still intact, and the benefactors, if you will, the companies that are actually going to benefit from these nuances that are going to create efficiencies and productivity that's going to continue to allow the earnings growth, we're not really taking into consideration. There's parts of the market that are trading at multiples substantially lower than that 22 times earnings. Call it 15 times earnings or 17 of those higher quality blue chip companies that are being overlooked. And those are certainly ones that are probably going to be the largest benefactors when all of this implementation and embracement of new technology and improvements will bring. And so that's positive. And let's talk a little bit about the Fed. I mean, let me ask you this. Maybe I'm being naive. Maybe I'm being blind. But we haven't had data since September. And last time I looked, the data was, I mean, I think you had a better chance of getting struck by lightning than missing numbers as badly as they did, which let's leave that for
Yeah,
another time. But how do you sit here and tell me rates
yeah,
aren't going up or down? We don't even have any data. To me,
that's
it's
right.
imagine if you're 30,000 feet above the clouds and the ground, and all your as a pilot, all of your videography and all of the different utensils and technology you use to identify how high you are, how fast you're going, all of a sudden goes off the screen. You're flying blind. That's a scary feeling. I think we're dealing with a little bit of that right now. What says you?
That's exactly right. I think the Fed is going to meet in December before we get a whole bunch of data that has been, collected and maybe even not even collected thoroughly. And I can see why the market, and I can see why some on the Fed. In fact, that was the headline, is that some of the people in the Fed have been talking, and they're out there giving speeches all the time. But I think they're all basically saying, look, we're not going to move without some good data and hard data, not the soft data that comes out from time to time, but the hard data. Basically, I think they're just punting is what they're doing, and I think a lot of folks thought, back in September and October, that, oh my goodness, we got a rate cut. It looks like we're going to get another rate cut. This is the beginning of a series of rate cuts. And all of a sudden they're tapping the brakes saying, wait a second here. Now, the good thing is, inflation's running at about 3%. It's not 2% like the Fed would like it to be. It didn't stop them from cutting rates, a few months ago. The fact that we hadn't got the 2%, the fact that they're at 4 from a Fed funds target rate is a sign that they've got room to maneuver. So if we do truly end up getting into a soft patch in the economy, the Fed has room to cut rates. And I think the Fed is trying to hold their rates. Powell definitely has been in that camp. He's held rates above the inflation rate now for the last couple of years, whereas throughout the pandemic and even those years leading up to the pandemic, the Fed was at or below the inflation rate. I think it's better from an investor's perspective to have the Fed with some dry powder to
Base.
to implement if they need to, if the economy does soften.
They're out of if they're out of bullets, that's a bigger concern. They actually have
That's
bullets
right.
in the tank. I use the example of when we were kids and there was a tornado watch or warning, right? The difference between a watch and a warning is warning, we have one in our surroundings. Watch, we may have one coming. I think we're in a Fed watch, not a Fed warning. And maybe that's actually the safer bet and gives us the ammunition to move forward. And we are in uncharted territories because we don't have data and we haven't been here before for different reasons of technological and others. So I ask you, what do you anticipate? Well, I don't think anyone can predict the Fed. I think the change of the Fed chair is probably imminent. That'll bring some concern and uncertainty, but probably positive ultimately. What is your outlook for, call it earnings growth for the fourth quarter and as well, call it 26 and,
Yeah.
and valuations of the like?
Well, right now the earnings estimates from a consensus perspective imply the earnings will be up around 12-13% next year. That is quite an improvement compared to where we were at times earlier this year. So, one of the things that I always say is, we pay attention to earnings. What really matters is what do the analysts do with their estimates going forward. And as we have gone through quarter after quarter throughout this year, we have seen earnings expectations for next year go up. And I think that's the main reason why the market has had as good a year as it's had. I think we'll end up with earnings this year. Once we get the fourth quarter numbers, earnings will be up around 10 to maybe 11, 12%. We've got a market that as of this morning was up around 12% year to date. So it could very well be the near term. We just kind of mark time and, wait until we get these economic reports. We start to see more guidance from the Fed in terms of rate cuts and whatnot. And then we get to the and all of a sudden here we are. We're in about 8 weeks, we're going to be digesting earnings reports for the fourth quarter. And I think at that point, once the market starts to see a little more clarity from the Fed and they hear from companies in terms of how they did in the fourth quarter, I think that those will be important points. And if we go down or up much from here, I'd be surprised. I think we're going to stay kind of range bound for the next couple of months. But I think we're setting ourselves up for another good year next year, as long as companies continue to make money. And that's really what it's all about. Is we need inflation to stay under control. We need interest rates to stay reasonably low. And obviously, events around the world, they happen. And I think next year is an election year. We don't tend to see massive shifts in policy during election years. For the most part, we've got both parties jockeying to gain or regain power or maintain power. It's kind of a stalemate year from a policy perspective. Markets tend to like that. We'll see how this plays out. But at the end of the day, I think we've done well with both parties in power at times. We are a country of entrepreneurs and investment people. I mean, ultimately, the companies that make up the economy are the ones driving the investment in the economy, and nobody in the world has ever done it better than what we see now here in the U.S.
There we go, U.S. So recently, a lot of reports have come out at the firm that I'm custodian with and use for research and banking and all the other things that we would want to be attached to, be it separate from a fiduciary focus on our clients versus the shareholders. A lot of words there. Any questions, talk to me one-on-one. But the reality is Wells Fargo has come out recently and says, international, emerging markets, we think those are more opportunistic. U.S., not so much. I don't know where that's coming from. It doesn't make sense to me. The reality is yeah, the markets here have been a little lackluster relative to the international and emerging markets. Some of that's driven by trade. Some of it's driven by the fact that we've had such a wild upside U.S. driven since 2017 tax changes. Now with the implementation of those tax changes being permanent, this call it July 4th, big beautiful bill, clarity on that front. How does the U.S., in your opinion, line up as it relates to competitiveness and markets and growth, et cetera?
Well, within the developed world, we are head and shoulders better as far as economic growth is concerned. We've got better companies. All of the leading edge companies in the tech space are U.S. based. Now, they do business all over the world. When you own the S&P 500, about 40% of the revenue underneath that index is derived from activity outside the U.S. Investing overseas, there's risk involved. You've got currency, you've got potential, changes in the political environment and so forth. You've got much larger deficits and government regulation in Europe, for example, than the U.S. and to some extent in Japan. I think the emerging markets in some parts of the world, India in particular, are intriguing. At the same time, I think the impact, of China cannot be ignored. China is a huge part of the world economy, and is China really an emerging economy anymore, or is it kind of a blend of a Western economy and an Eastern economy, a market, more of a government controlled economy? It's hard to really categorize. It makes sense to me to have something overseas. You've got to have investments overseas, but the idea that you just get out of the U.S. and just go overseas, I don't buy that. I think we are more expensive, but we've got better companies, and I think that as long as companies keep delivering here, I think we will see outperformance. I think most of the outperformance in international markets this year is just the dollar. The dollar fell quite a bit in the first half of the year. The dollar has been relatively stable in the last 4, 5, 6 months. It was really more of a dollar story. The dollar was probably in need of a correction. That's exactly what happened, and we got a bit of a jolt. And we have seen central banks in Europe in particular get more aggressive at cutting rates. And so I think at the end of the day, the dollar, I think, will probably hold up. I think we're going to be more likely to keep interest rates relatively high compared to Europe, and I think that will help strengthen the dollar a little bit. I think that's one reason why you're seeing some of the inflation indicators begin to come down, is that we've got these tariffs behind us. We kind of went through that. That affected the dollar in a huge way, but now we've got, like you say, we know where we're at with some of these things.
Percentage of international versus domestic on a long-term, moderate to moderately aggressive portfolio. What says you?
I think 20% international makes some sense. Maybe 5%, 3 to 5% emerging.
Yeah.
But I wouldn't go too much more than that.
Good. Very good. Have to ask, crypto's been on the downtrend. You've talked about the fact that that has been a leader in the market's pullback. I think that's pretty consistent here the last couple of years. Very a nuance monitoring of that, because I've been doing this 30 years. It hasn't been a topic up until the last 5. You know, US dollar, Bitcoin, currencies in general. Thoughts?
Yeah, I think the appeal of crypto and other, just in general, I think whether it's gold or crypto, I think all these inflation hedges, um, I think if it hadn't been for the huge increase in the money supply during COVID, we wouldn't even know about these assets. I think investors have been looking for ways to hedge a little bit against inflation. And we did have inflation during COVID, and just after COVID kind of concluded, we had inflation that we hadn't seen since the 1970s. And it was in fact monetary policy driving a lot of that inflation. So I think ultimately investors, unfortunately, a lot of investors chase the kind of fight the last war. And, I think a lot of folks have gotten speculative. For me, it's very hard to value things like cryptocurrency. I just don't know what the numbers should be.
Did you get your dividend? Did you get your
Yeah,
dividend
there's
from
no
your Bitcoin
dividend.
yet?
The one
Did you
thing
see
that
the
cryp-
earnings? The
the one
earnings
thing that
Bitcoin brought?
crypto has, to me, the embedded value of crypto is liquidity. You can move an incredibly large amount of money very, very quickly, which it's hard to do in other asset classes. Jeff, if you decided to blow out $100 million out of your clients' accounts across markets and then wire that money to them the next day, you can't do it. It's very, there's a step, there's settlements, there's a process of setting up these wires. Crypto, you can move a lot of money very, very
So
quickly.
let me ask you this, Bob.
Yeah.
Stablecoin, Tether, these technologies that Circle and other companies are gravitating to, and companies are hiring them to help the execution process be more modernized versus the SWIFT system, which is archaic.
That's
How is
right.
that any different from what you're describing with Bitcoin?
Well, it's related, obviously, and I think that is. I think you've got to me, you've got natural market forces that want more liquidity, that want more freedom, if you will, to move capital more efficiently and more quickly without a lot of regulation. And to me, a lot of this stuff has been created um, because of inflation and because of archaic systems that have been mandated by government agencies and by governments. To me, that there's always this struggle between the market and what people want to do and what more or less the regulatory forces of the world want to do and keep. It's just natural tension between those two entities over time. And I think that's where I think the rise of Bitcoin and other payment systems is putting a lot of pressure on governments to modernize their payment systems and markets. And you're right, SWIFT, all these things have been around forever. And to me, it's like the FAA. A friend of mine, his son works as an air traffic controller, and it's a government system that regulates flights, and it's they do an amazing job. Thankfully, we have very, very few aviation accidents, but underneath it all, we've got a lot of old technology in these systems, and I think we're testing our boundaries for some of these things from a financial perspective, from an operational perspective, across the financial system as well as the economy. And it's an age-old issue, and it's hard to say how this is going to play out.
What I hear you saying is competition good.
Yeah.
Competition putting pressure on the old mentality and processes that need to be updated, whether it's Tether putting pressure on, or stablecoin putting pressure on the SWIFT system, or Bitcoin putting pressure on running a balance sheet that it could be under more pressure due to other options. Pressure. pressure and competition create the most, and that's capitalism. And I don't see how that's a bad thing. I think that creates everyone's ability to focus on the task at hand and be efficient as possible, because that's what brought this country to where it's at. So I think what you're saying is healthy. And I also tell you the healthiness that I see with this market correction is we're retesting, we're reassessing, we're considering alternatives that could transpire based on history. And what I've learned is not doing that has been more harsh than doing that. I also know that there's a narrative that will grab us, whether it's fear or greed, to make us do things or consider things that probably don't make sense. So my call to action is, thank you, Bob. I'm thankful for you. I'm thankful for my team. I'm thankful for my audience. And I call to action for everyone to say, let's assess things. Do we have enough liquidity in place to protect us for what we know as well as what we don't know? What is that rule? Let's make sure we have enough liquidity for the next couple of years that we know of our expenses. And anything we know of large, call it injections of liquidity needed for the next 5 years, let's not put that at risk, because there's no way of knowing exactly what tomorrow brings. That's the same thing that we're doing in the markets today with testing. As well, let's understand that the cost of living, inflation, which is the topic here, that we put money to work that we are certain with high degree of compellingness that we're not going to need this portion of the money, whether it's in your retirement accounts or your long-term savings of discretionary assets. I know I don't need that for Jimmy's education or that roof or that expense. I know that that's meant for my legacy, if not my next chapter after my accumulation phase is done. And let's make sure that money is combating the cost of living. The cost of everything we do is being increased due to all the factors that we talk about. Let's make sure our money's working, because that, my friends, is the bigger concern in my view, getting too conservative and getting too aggressive, not one or the other. My call to action is continue to test the theories, continue to create competition, create a situation where we're leveraging every aspect we have to get that best advice. And that's who you are, Bob. You've been a partner of ours. First Trust has been a partner of ours. And we're so honored to have you. And I thank you. And I wish everybody a happy Thanksgiving, healthy. And let's not forget, we're always stressed by this, that, and the other thing. Yours truly included. But let's be grateful and thankful for all the things we do have. So thank you, Bob. And thank you, everyone. We see you soon.
Thank you, Jeff.
Bye for now.